Italy's comeback, Germany's industrial decline, major central bank shenanigans, and China's massive new stimulus. Bazooka. These are, in my opinion, the most important economic stories that we need to talk about in this economic update. So, let's dive into our first story right away, which is about Italy's comeback, which sounds a bit strange, right? Isn't Italy's economy supposed to be a basket case? Yes, actually, this comeback story came about due to a recent data revision in which Italy's 2023 growth was downgraded, but its 2022 and 2021 growth were both upgraded, and therefore overall Italy's economy has now officially achieved the incredible feat of rising above its 2007 peak. So essentially it took Italy 16 years to achieve what France did in 4 and the UK did in 6 years. Still, this economic comeback through a data revision is very important news for Italy because it makes its gigantic government debt appear smaller in relation to GDP, at least. But why did Italy perform so badly? And does this mean that there is now renewed hope for the future of Italy? Well, regarding its terrible performance up to now, I argued in my previous analysis of Italy's economy that it was likely a combination of poor productivity caused by Italy's inefficiently small firms, missing the IT revolution, and chronic underinvestment, especially in education, which was partially caused by overly harsh austerity measures introduced in response to the euro crisis of 2011. That being said, Italy's economy did actually do relatively well in the last couple of years, something that can, according to Italy's statistical office, largely be explained by a massive investment boom due to an insanely generous tax credit on home renovations, where the government would essentially pay people to renovate their homes. This boom is unlikely to last, meaning that I expect to soon again cover stories about Italy's weak economic performance, given that the country is still underinvesting in its population and continues to age rapidly. But in a plot twist few would have seen coming a couple of years ago, that would mean that Italy is in the good company of Germany, which is facing a broad-based industrial decline. Indeed, as you can see here, while the growth of Germany's industrial production has seen some wild swings around COVID, it now really seems to have entered a period of steady decline. This is very worrying because Germany is Europe's biggest producer by far, and its weak performance is dragging down the Eurozone's overall production by quite a lot actually. So why is Germany doing particularly badly? Well, the obvious answer is that its industry was uniquely benefiting from cheap Russian energy and therefore is now suffering more. A second convincing explanation is that Germany is now being hit hard by a China shock, in which Chinese demand for its cars and machines is plummeting, and at the same time, new Chinese competitors now challenge Germany's champions with competitive offerings in markets like Southeast Asia and Latin America. As a consequence, German exports are now far more reliant on the United States, which largely shut its market to the Chinese. But luckily for Germany, the Fed has recently started cutting interest rates, which may increase US demand, while China announced massive stimulus as well, which may increase Chinese demand for German exports. So this all coincidentally is what the next two stories are all about. So let's first get into what the big central banks have been up to in September. In short, the ECB and Fed started cutting rates in September, while the Bank of England and Bank of Japan kept them steady. Most of this was expected. Therefore, unlike with the Bank of Japan's rate hike in August, central banks this time did not cause another massive market panic. On the contrary, the Fed rate cut announced on September 18th was actually a bit larger than expected. So after this, US financial markets jumped quite a bit. More importantly, for the world, lower US dollar interest rates mean that other central banks now have more room to lower their own interest rates without weakening their currencies too much, causing inflation. But why are the Fed and ECB lowering interest rates while the Bank of Japan and Bank of England are more cautious? Mostly it has to do with inflation and, in the case of the US, employment. You see, the Fed has a so-called dual mandate, meaning that it wants both low inflation and low unemployment. And because employment data in the US was weaker than expected, the Fed cut rates by more than expected and told the world that it will likely cut rates even more soon. This means that the ECB now has more breathing room to cut its own rates even more in October, if, for example, weakness in Germany persists. On the other hand, because the yen has weakened so much already, the Bank of Japan felt like it could not lower rates even further. But the Fed lowering their interest rate did mean that the Bank of Japan could keep its interest rate stable instead of raising it, which is what it wanted to do initially. Finally, the Bank of England has indicated that it intends to keep cutting rates, but that it has stopped for a bit given that inflation has remained above target in the UK. Overall, my takeaway is that it still looks like the West's big inflation spike is a thing of the past and that central bankers are now likely to continue lowering rates given that Western economies have slowed down considerably. However, the nature of that slowdown is nothing like what the People's Bank of China is facing, where China just announced a massive stimulus bazooka with the goal of stabilizing its economy and increasing both property and stock prices. So far, the announced package consists of 5 key parts. First, the Chinese central bank lowered its interest rate from 1.7% to 1.5%. And the reserve requirements, which is the amount of capital banks need to hold at the central bank, by 7.5% to 7%. Next, to raise stock prices, the Chinese announced a new billion-dollar fund that will provide loans to companies to buy stocks on the stock market. Fourthly, to boost home prices, China's central bankers announced that they will lower the down payment needed to secure a mortgage on a second home from 25% to 15%, while also making it easier for local governments to sell unsold homes. Finally, the Chinese government announced that it will soon start spending more itself to stimulate the economy. Fiscal policy. This new move is extremely relevant for the state of the global economy as a whole, because many economists see China's gigantic exports mainly as a consequence of low demand in China itself. In turn, China's export surplus was slowly leading to a trade war. So if China can genuinely stimulate its economy, it could seriously lower global tensions. But will this stimulus bazooka work? Well, unless the fiscal stimulus will be big, I highly doubt it. Sure, these current measures have already helped to boost asset prices, as immediately after the announcement, stocks in China, Hong Kong, and even in Europe posted significant gains. However, for me, this really reminded me of the stimulus done in both the West and Japan after their respective property bubbles popped. Here, research has since shown that central banks' stimulus like this largely leads to asset price inflation, which may help some people struggling with debt, sure, but at the same time, it does not address the fundamental underlying problem that led to the bubble in the first place. Therefore, China's new stimulus measure should be seen as part of a broader effort to reshape its future. But understanding the full picture requires deeper insights that only a publication like The Economist can offer thanks to their in-depth coverage of China. For example, their recent article, Anger Abounds as China Raises Its Strikingly Low Retirement Age, dives into the societal challenges behind its recent move to raise the retirement age. While the article, The Chinese Authorities Are Concealing the State of the Economy, exposes how China increasingly manipulates its economic data. That's why I'm excited to share that Money Macro viewers can now get 20% off an annual subscription to The Economist, which gives you full access to their daily in-depth global reporting for an entire year. What I love about The Economist is that they stand for independent journalism for independent thinkers. This is why they've been a part of my media diet long before I started this channel. Whether you prefer the print edition or their app's digital weekly edition, you'll always stay ahead of the news no matter where you are. So, don't miss out. Click the link in the description or top comment, or head over to economist.com/moneymacro to claim your exclusive 20% discount today.